Welcome back to FBS Growth School. Today we're going to explore an exciting topic: how stocks compare to other popular asset classes like bonds, real estate, gold, and even cash.
That's right. Understanding the differences between these asset classes is essential to building a well-balanced investment portfolio. Let's dive right in.
To start, let's define asset classes. These are categories of investments that behave similarly in the market. Stocks are just one type of asset class. Others include bonds, real estate, commodities like gold, and cash.
Each asset class has unique characteristics, risks, and returns. For instance, stocks are known for high growth potential but come with volatility. Bonds, on the other hand, are considered safer but provide lower returns.
Think of asset classes as different tools in a toolbox. You need the right mix to build your financial future effectively.
Let's start with the most common comparison: stocks versus bonds. Stocks represent ownership in a company, while bonds are like loans you give to a company or government.
When you buy a stock, you're betting on the company's success. If it grows, you can earn high returns. But there's also the risk of losing money if the company performs poorly.
With bonds, it's different. You're lending money in exchange for regular interest payments and the return of your principal at maturity. Bonds are generally safer, especially government bonds, but their returns are lower than stocks over the long term.
For example, a stock might earn you 8 to 10% annually over time, while a bond might give you 3 to 5%. The trade-off? Stability versus growth potential.
And bonds are also great for balancing risk in your portfolio. They're less volatile than stocks, which is why many investors include them for stability.
Now, let's compare stocks with real estate. Real estate involves investing in physical properties like houses, apartments, or commercial buildings to earn rental income or capital appreciation.
Real estate is often seen as a tangible, secure investment. People like it because you can see and touch what you own. Plus, it provides regular rental income, making it attractive for passive investors.
However, real estate has its downsides too. It requires significant upfront capital, ongoing maintenance, and isn't as liquid as stocks. If you need cash, selling a property can take weeks or months.
Stocks, on the other hand, are highly liquid. You can buy or sell shares in seconds. Plus, stocks offer more diversification opportunities than real estate. You can invest in hundreds of companies with the same amount you'd need for a down payment on a property.
True. But real estate does provide a hedge against inflation. When prices rise, so do property values and rents, which can protect your purchasing power.
Next up is stocks versus gold and other commodities. Gold has been a symbol of wealth for centuries and is considered a safe haven during economic uncertainty.
When stock markets crash, gold often rises in value because investors see it as a safer store of wealth. But here's the thing. Gold doesn't generate income like stocks or bonds. Its returns depend entirely on price appreciation.
Exactly. Gold might preserve wealth, but it doesn't grow it. On the other hand, stocks create value through dividends and share price growth.
The same goes for other commodities like oil, silver, or agricultural products. They can be great for hedging against inflation, but aren't long-term growth assets like stocks.
So, while commodities can diversify your portfolio, relying solely on them isn't a smart strategy for long-term wealth creation.
Now let's discuss stocks versus cash. Keeping money in cash or savings accounts might feel safe, but is it really a good investment?
Not really. While cash is the most liquid and risk-free asset, it doesn't grow. In fact, inflation erodes its value over time. If inflation is 4% and your savings earn 2%, you're effectively losing purchasing power.
On the flip side, stocks historically outpace inflation. Over decades, the stock market has delivered average annual returns of 8 to 10%, far exceeding the returns on cash or savings accounts.
That's why experts recommend keeping only enough cash for emergencies and short-term needs. The rest should be invested for growth.
To summarize, each asset class has its strengths and weaknesses. Stocks, high growth potential but volatile. Bonds, stable income but lower returns. Real estate, tangible and inflation-proof but illiquid. Gold, commodities, great for hedging but not income generating. Cash, safest but loses value to inflation.
The key is to diversify across asset classes to balance risk and reward. By understanding how these investments work, you can make smarter decisions and achieve your financial goals.
Thank you for joining us today at FBS Growth School. In the next session, we'll learn how to read financial statements, a skill every investor must master.
Don't forget to like, share, and subscribe to Future Business School for more growth videos. Thanks for watching.